Consistently catching explosive market moves is possible, but most traders miss them because they focus on random candles instead of the structure institutions actually respect. Look at this chart. Notice how price suddenly launches away from a single candle with almost no drawdown. Most traders ignore that signal completely. The truth is these moves are not accidental. They are engineered around very specific price structures and liquidity behavior. So here is the real question. Are you recognizing these setups or trading blindly? By the end of this video, you will understand the propulsion block framework and how it reveals high probability price movement. Let's get started. Our focus today is strengthening your understanding of order block theory. In this lesson, we are going to discuss propulsion blocks. A propulsion block is defined as a candle or price bar that has previously traded downward into a bearish candle or bullish order block and then assumes the role of price support for the continuation of higher price movement. In this example here, we can see a down candle that reveals the market's willingness to move higher. Then we see another candle that closes down and trades directly back into it. As illustrated here, the candle now becomes what we refer to as a propulsion candle. The reason it qualifies as a propulsion candle is because price has already retraced into an order block that is already predisposed for higher price delivery. After that occurs, another higher bullish order block is formed that touches the initial one. This new higher level bullish order block, which is represented by the down closed candle, will become extremely sensitive. Ideally, price should never violate the mean threshold. In other words, price should not break halfway through the body or close above or below the midpoint of that candle's range. That midpoint level should remain intact. The sensitivity becomes even more amplified when price trades back into the high of the candle. We are willing to allow price to trade into the middle of the range or the mean threshold. However, most of the time it will not even do that. Typically, price will simply trade back into the high of the candle and then immediately explode away from it. Occasionally, it may trade 1 or 2 pips below the high of that specific down candle that we are identifying as the propulsion block. Once that occurs, the market will show a sudden and aggressive movement away from that candle. That behavior defines the propulsion candle. Now let's look at this concept in real price action so we can get a clearer visual understanding of what it looks like. Let's begin by examining a bullish propulsion candle. You can observe that price moves upward from a low here, and we are currently positioned on the buy side of the curve. Inside this area, the market prints several down candles. We would treat these as one complete bearish candle because we have 3 consecutive down candles. So the bullish order block is framed using those candles. If equilibrium were positioned here, price could trade down into that level. But notice that price does not actually reach equilibrium. Instead, price trades lower here and then rallies through its own 3 consecutive down candles. That means those 3 candles together form the order block. Then we observe this candle here. Notice this down candle. It is trading back into those down candles, so collectively this becomes one bullish order block. It represents downward price movement searching for a level where buying interest will appear. After that occurs, price moves upward through this candle here and trades above the highest of the down candles. That confirms the presence of a bullish order block. The very next candle trades higher. Then the following candle opens and trades downward into this candle here. When that candle forms a down close and finish closing, it becomes a propulsion candle. What makes it a propulsion candle is simple. Another down candle has traded into a previous down candle while the overall context remains bullish. The powerful characteristic of a propulsion candle is that you almost never see the mean threshold violated. You will often see price trade back into it, as it does here. This candle opens and trades directly into it at this point here. The open appears here. The low of that candle forms here and taps directly into the candle we are referencing. That creates a bullish entry opportunity using the propulsion candle. Again, the concept is straightforward. It is simply a down closed candle that trades back into another previous down closed candle. That candle represents an order block. The down candle trades into that order block, which creates a bullish condition. After that, price moves higher and then returns to test this candle again. This candle becomes what we refer to as the ICT propulsion candle. That means we should expect immediate responsiveness from price. Bullish price movement should launch higher from that candle when it trades back into it. Here is the key clue. If the mean threshold of that candle breaks, and it has already traded into a previous order block that is bullish, the trade is likely not ideal. If the mean threshold fails, there is a strong probability that the setup is not valid. Because of this behavior, you can place an extremely tight stop loss on a long entry. Or you can receive immediate confirmation that you are positioned on the wrong side of the market. When that happens, it may be better to remain on the sidelines. In many situations, you may even consider preparing for a reversal opportunity to sell short. Now let's examine an example of a bearish propulsion candle. We will structure this example around a higher bearish order block. It is located at this candle here. Price trades upward into that level and then breaks downward. Now we introduce another layer of order block theory. We identify this final up candle. That candle represents the bearish order block. We also reference the previous candle as well. Now observe what happens next. Price begins to move lower. Then it trades directly back into this order block here. That candle becomes the propulsion candle. Right here, this one. Now we divide that candle in half. Price touches that midpoint level. That represents the mean threshold. Immediately after touching it, price moves lower. That provides a sell entry using the bearish propulsion candle. A trader could initiate a short position there. There is also another entry opportunity later, when price trades back into the low of that candle, right here where it taps that level. Notice the immediate responsiveness afterward. Price quickly moves lower. After price trades into that candle, you must see it break below that candle's low, which it does here. That confirms the market is unwilling to move above that mean threshold. Price breaks downward and then trades back upward into the candle's low again. It does not need to reach the body. It stays below the propulsion candle. Because propulsion candles are extremely sensitive, once price taps them you should see immediate reaction. That quick responsiveness is exactly what we expect. This is the reason the concept was named a propulsion candle. It propels price quickly and aggressively. It provides immediate feedback. There is very little drawdown. And price reacts almost instantly. That type of behavior is exactly what short-term traders want to see. Hopefully this concept has been insightful for you. In the coming months we will continue sharing additional information as we map out more models and setups. We will also explore when propulsion candles are most likely to appear. That's it, traders. Thank you for watching. I hope this explanation delivered greater clarity and practical insight that you can apply to your own trading. Make sure to subscribe and turn on notifications so you never miss future content. Leave your questions and suggestions in the comments section below. And let us know which topics you would like to see covered next. We truly appreciate your support, and we look forward to seeing you in the next episode.